Friday's closing bell didn't just end the week, it triggered a mechanical event moving $334 billion in seconds. That record burst locked in a violent rotation out of big tech and into everything else. Heading into the new week, Sunday, June 28, 2026. Like and subscribe for daily market updates. Today's agenda: week in review, the bond market check, commodities and crypto, tech earnings and rotation, major deals spotlight, index rebalance breakdown, week ahead risks, market snapshot, closing thoughts. Up next, the bond market check. This week in markets looked sleepy on paper, but was actually a massive reshuffle beneath the surface. The S&P 500 ended Friday almost perfectly flat, near 7,354 points. That calm is just a disguise for what happened underneath during trading hours. The Nasdaq fell for its fifth straight session and closed out one of its worst weeks of the year, down roughly 3 to 4% as investors fled crowded bets on artificial intelligence. Meanwhile, the Dow Jones finished a whisker below a record near 52,000 points. But the real story is happening in commodities, where global politics are driving prices up fast. Commodities and crypto update. The bond market aligned with the stock split observed earlier this week. 10-year Treasury yields eased to approximately 4.4% as investors sought safety in cash, while equities faced significant selling pressure. This yield decline lowers borrowing costs for corporations, yet it signals investor concern that inflation may persist longer than anticipated. Meanwhile, the dollar held near a one-year high, creating headwinds for exporters such as Boeing and Caterpillar, who rely heavily on overseas sales. The divergence between bond yields and equity performance highlights growing uncertainty about future economic conditions. Investors are weighing the benefits of lower financing costs against the risks posed by sustained inflationary pressure and a strong currency that erodes competitiveness in global markets. Companies with substantial international revenue streams face particular challenges as their products become more expensive for foreign buyers without corresponding price increases abroad. This dynamic could compress profit margins if demand softens or if competitors from countries with weaker currencies gain market share. Market participants are closely monitoring central bank policy decisions and inflation data to gauge whether the current trajectory will sustain or reverse. The interplay between yield curves, currency valuations, and corporate earnings remains a critical focus for strategists managing portfolio risk in this volatile environment. That brings us to tech earnings and rotation. That global political whipsaw rippled straight into oil and crypto markets overnight with significant consequences. Oil closed at a 2-month low with U.S. crude near $69, only for weekend strikes to start nudging those barrels back up towards $72 per barrel soon. Gold staged a quiet comeback after dipping below $4,000 an ounce midweek, which leads to major deals spotlight. The engine room of this week's market rotation reveals a sharp irony at its core. Technology stocks were pushed lower by their own recent triumphs. Memory chip giant Micron delivered blowout earnings, sending shares soaring to new highs before abruptly reversing course on Friday and tumbling nearly 7%. This sudden rate change dragged the entire semiconductor complex down with it, signaling that investors are rapidly recalibrating how expensive assets look relative to earnings after a frenzied run-up. The mechanism here is classic profit-taking. When growth stocks rally too fast without fundamental earnings catching up to price targets, available cash in the market dries out quickly as traders lock in gains. Historically, this pattern mirrors the 2018 tech correction, where massive rallies were followed by sharp retracements once momentum faded, and fears of a rate hike cycle took hold. The second-order effect is visible across related sectors. Software vendors with heavy exposure to chip demand are now facing heightened scrutiny on revenue visibility. For concrete investor implications, this rotation suggests that chasing yesterday's winners has become dangerous. Capital is fleeing high-flying names for defensive plays or value stocks offering better downside protection. Traders must watch volume profiles closely, as the speed of Micron's decline indicates institutional selling pressure rather than a mere retail shakeout. Here's index rebalance breakdown. Corporate deal-making remains strong, with Merck advancing its strategic purchase of biotech to bolster oncology capabilities and diagnostic revenue streams. This consolidation lifted shares approximately 20% as investors already expected by the market enhanced long-term cash flows and reduced competition for key assets. Conversely, chipmaker ON Semiconductor saw its stock slide following a $7 billion acquisition aimed at securing advanced packaging capacity amidst global supply chain bottlenecks. This shift highlights how capital allocation strategies now heavily favor vertical integration to mitigate global political risks rather than pure horizontal expansion. The market mood was further defined overnight by a significant development in the artificial intelligence sector. OpenAI is reportedly delaying its anticipated initial public offering until 2027, effectively abandoning plans for an immediate debut below a $1 trillion valuation. This rate change suggests that even dominant tech giants now prioritize profitability and sustainable unit economics over rapid available cash in the market, events driven solely by hype cycles. Historically, such delays often signal maturing markets where investors demand clearer paths to earnings before rewarding massive scale alone. For portfolio managers, this implies increased caution regarding speculative AI, how expensive assets look relative to earnings, while maintaining exposure to established biotech consolidations that offer tangible asset synergies and predictable return profiles in an increasingly regulated environment. On to week-ahead risks. Friday's record index reconstitution did more than merely reflect shifting market dynamics. It fundamentally bolted these structural changes into the very DNA of major benchmarks like the S&P 500, altering how capital is allocated for decades to come. In a telling twist driven by evolving valuation metrics and earnings stability rather than just sector labels, tech giants Apple and Microsoft were reclassified as part-value stocks for the first time in their modern history, acknowledging that their massive market caps now behave more like mature utilities than high-flying growth engines. Conversely, memory chipmakers Micron and SanDisk were moved fully into aggressive growth categories following a stunning 20% rally, validating their transition from cyclical hardware plays to essential AI infrastructure builders. This mechanical shift forces passive funds holding these indices to rebalance portfolios automatically, selling overvalued tech giants while buying the newly designated high-beta chips. Historically, such rigid categorization changes are rare. Usually, index rules lag behind reality until a crisis forces action. Today's move signals that investors must adjust expectations for lower dividend yields from Apple, and Microsoft in favor of higher unpredictable price swings exposure to semiconductor leaders, effectively rewriting the risk-return profile of the entire technology sector without any legislative change or market crash required. Here's where things stand right now, heading into the new week. Market snapshot. Looking toward next week's calendar, the trading landscape appears short on available cash in the market, yet dangerously loaded with unpredictable price swings for investors exposed to stocks and high-yield debt right now. This heightened uncertainty stems directly from a critical rate change point in central bank policy, an upcoming jobs report scheduled midweek that could decisively settle the ongoing debate over interest rate hikes once and for all. Historically, markets have punished premature positioning before such data releases, as seen repeatedly during previous employment shocks, where second-order effects, such as sudden bond yield spikes or equity sector rotations away from growth stocks, took investors by surprise. The mechanism at play is straightforward but potent. If the report signals cooling labor dynamics, expectations for further raising interest rates may surge, crushing risk premiums instantly. Conversely, strong figures could trigger a flight to safety before policymakers act. With U.S. markets officially closing Friday for Independence Day, available cash in the market will thin significantly on Thursday and Monday morning, amplifying price swings around this pivotal data drop. For concrete investor implications, this environment demands strict stop-loss discipline and reduced borrowed money in volatile sectors like small-cap tech or leveraged loans. Positioning ahead of the print is no longer optional. It is a defensive necessity to avoid being caught off guard by potential regime shifts that could redefine how expensive assets look relative to earnings across the board within hours rather than days. So step back. This week the market didn't fall, it rotated. Closing summary. Bitcoin tumbled sharply on Friday, sliding down to approximately $58,000 during trading hours before staging an aggressive recovery toward the psychological $60,000 level, where it has since consolidated over the weekend. This asset now commands a total market valuation nearing $1 1/3 trillion, reflecting its continued dominance as digital gold despite recent unpredictable price swings. The precipitous drop was largely driven by profit-taking following weeks of relentless gains, triggering stop-loss orders that amplified selling pressure, before buyers stepped in to stabilize prices near key support zones. Ethereum followed suit with similar mechanics, sagging to roughly $1,550 as investors rapidly reduced exposure across the entire crypto ecosystem amid broader big-picture economic uncertainty regarding interest rate expectations and regulatory headlines reminiscent of the 2022 winter crash. This second-order effect demonstrates how available cash in the market crunches in traditional finance can quickly spill over into decentralized markets, forcing a rotation out of high-beta assets regardless of underlying health. For investors holding these positions, this consolidation phase offers a critical opportunity to reassess risk tolerance and potential entry points before the next major trigger emerges later this month. Finally, let's turn to closing thoughts. This week, the market refused to retreat. Instead, it executed a disciplined rotation, transferring dominance from an overextended cluster of mega-cap technology giants toward resilient sectors like healthcare and banking, alongside undervalued small caps seeking yield in uncertain times. Friday's record reconstitution was not merely symbolic but structural, permanently embedding this shift into index composition by mechanically excluding the most expensive growth stocks, while admitting cheaper alternatives with strong free cash flow. Historically, such broadening often signals a maturing cycle, where available cash in the market seeks safety after a prolonged run-up. Last decade saw similar pivots during early 2018 and late 2020, when rate fears forced capital out of tech into defensive value plays. The mechanism here is clear. As valuation compression widens across the S&P 500, passive funds must sell winners to buy laggards, forcing a self-correcting rebalance that dampens unpredictable price swings. For investors, this implies reduced reliance on single stock concentration and an opportunity to capture alpha through factor tilts toward quality value rather than chasing momentum. The DNA of major benchmarks has changed, suggesting future rallies will likely be more inclusive and less dependent on the narrowest set of high-flying names driving returns in previous years. This week, the market didn't fall, it rotated, handing leadership from a handful of giant tech names to healthcare, banks, value, and small caps effectively. And Friday's record reconstitution didn't just reflect that shift, it bolted it into the index's very DNA permanently. Thanks for watching Market Pulse Daily.